We have a special guest joining us, Nilesh Shah, Managing Director, Kotak Mahindra AMC, joining us. Good afternoon, Mr. Shah. I'm Harsh Saita here. Wanted first off your quick take with regard to everything that's happening in markets, that is the market reaction to both the India-UK FTA as well as everything that's happening on the border. Just give us your 2 cents on how an investor should react or respond in the current environment.
So markets are driven by funds, fundamentals, and sentiments. From a flow point of view, domestic institutional investors have been buyer led by mutual funds. The SIP culture brings every month regular flows, and mutual funds buying has been regular. Foreign portfolio investors joined the party and they became buyer in last couple of weeks. There has been no significant supply from IPO or QIP or OFS. Clearly, with DII and FPI buying, market is balanced in favor of rising prices for lack of supply. From a fundamental point of view, we have seen March 25 quarterly results coming ahead of expectation. While there are some misses, collectively, corporate India has delivered results ahead of expectation. This quarter, Nifty earning could be somewhere around 275 rupees, and that will take FY25 Nifty 50 EPS to somewhere between 1050 to 1065. With flows and fundamentals in place, driver for the market is sentiments and events. While conflict with Pakistan obviously is an event to watch out for, the positive event was India-UK FTA. This FTA has come in a win-win situation for both India and UK. And if this FTA agreement is harbinger of what will happen with EU and US, clearly Indian manufacturing and Indian exports stands a better chance. So overall market has been fairly positive because of the flows and fundamentals. And even today's conflict, market is pricing in that it will not be escalated. It will remain, under control. And with that anticipation, market is behaving moderately.
Hi, good afternoon, Hiral, on this side. I mean, an interesting take, because as steady as what the markets are, they are absolutely mirroring the steady strategy in terms of the strike as well. But going ahead from here on, from a retail investor perspective, do you think this valuation is going to be ripe enough to start nibbling in? And if so, which are the sectors that you would recommend?
If you are looking as a long-term investment, then these valuations are fair. They are neither cheap nor expensive. If you are looking from a short-term point of view, well, valuations will depend upon events. As I mentioned, flows, fundamentals, and some of the events are positive for the market. So, since we can't predict future and events, it's better to be a long-term investor. From a sectoral point of view, we believe consumption is one sector to watch out for. The tax cuts proposed in the last budget will put about 1 lakh crore in the pockets of taxpayers. Interest rate cuts will reduce EMI burden for investors, for borrowers, and that could also support consumption. The Eighth pay commission should be effective somewhere around 2027 beginning. That also will support consumption over a period of time. Crude prices have come down, which creates room for petrol diesel price cuts. If that materializes, again money is left in the pockets of consumers. Between income tax cuts, EMI burden coming down, potential petrol diesel price cuts, and eighth pay commission benefits, consumer discretionary space looks like a market outperformer.
So you're looking at the discretionary space as the outperformer. Nilesh bhai, how supportive are the FIs? Because the read in the market was that probably if there is any escalation before Operation Sindoor, there's a possibility FIs would not be as positive on the India story. Yes, you're looking at growth, but your geopolitical aspect also comes into consideration. Along with your domestic investors, you have that support coming in from the FIs as well. This combination, how good a deal is it?
So undoubtedly FPI are major player in our market, but their influence is coming down. Now DII holding is ahead of FPI holding. Undoubtedly, they are fully aware of geopolitical situation between India and Pakistan, and yet they have started investing. Now, if there will be escalation, undoubtedly their reaction could be to take money out of India. But that will be again a temporary thing. Ultimately, I still believe FPIs will invest for India growth story. We are truly an oasis in the global desert. Our growth story is intact, and probably FPI at this point of time, looking at Pakistan's economic situation, looking at isolation of Pakistan on global stage, looking at the advice from US to Pakistan, don't even think of retaliation against India. There are many things which I'm sure they are considering and watching, and we believe while it's difficult to predict their behavior, I think they will be buyers of the India growth story.
Nilesh bhai, last question with regard to how you view the Indian macro, especially from a small and mid-cap perspective. There was plenty of conjecture that small and mid-caps a few months back were sitting at slightly elevated valuations. Do you believe we've seen a sizable enough correction in terms of comfort for someone of your stature to say that we are now at a place where valuations are more reasonable, or would you still continue to believe that they are elevated?
So, small and mid-cap space is more micro than macro. Each company has different growth trajectory, each company has different governance structure, and hence you have to do a far more bottom-up analysis to invest rather than top-down. Mathematically, even today, small and mid-caps are trading at a premium to their historical average compared to large cap. There is no way one can say that small and mid-caps are looking cheaper from a valuation point of view. If at all, they are marginally priced ahead of large cap. My feeling is that if you want to invest in small and mid-cap portfolio, focus on quality, focus on earnings growth. You might end up paying a little higher price at current valuation, but if you have chosen right stocks over a period of time, they will deliver the return. Keeping with uncertainty in the market, our recommendation is to be marginally underweight small and mid cap, marginally overweight large cap, and keep neutral allocation to equity.
Okay, thank you so much, sir, for joining us on this very, very critical day and giving us all of those views and perspectives. Interesting conversation with Nilesh Shah. But let's